The NIO revolution and the legacy auto counteroffensive. This is not your standard dry quarterly earnings summary. In my opinion, this reads like a geopolitical thriller. It really does. Instead of the usual story about a struggling Chinese startup, my analysis suggests that we are witnessing a coordinated high-level fear campaign. The thesis is that legacy automakers, Ford, GM, the giants, are terrified. And they aren't terrified because their competitors are failing. In my view, they're terrified because companies like NIO are succeeding in ways the legacy brands literally cannot match mathematically. So the mission for this analysis is to look behind the curtain. I'm talking lobbying, hidden infrastructure deals, and some baffling moves by big banks. Let's start with what I call the narrative war and the concept of institutional capture. Institutional capture is when independent entities, media outlets, regulatory bodies, analysts start parroting the specific interests of a corporation. I've noted that commentary from figures like Yahoo Finance's Pras Subramanian often mirrors the exact rhetoric used by Ford CEO Jim Farley. In my opinion, you have to ask, is that a coincidence or is it strategy? You might ask, what is the specific rhetoric raising red flags? It's the shift in framing. The criticism isn't about the product anymore. They aren't saying our range is better or our software is faster. The narrative has shifted entirely to framing Chinese EVs as geopolitical weapons or national security risks. This moves the battlefield from product versus product, where you decide, to politics versus safety, where the government decides. My analysis identifies the source of this noise as the Alliance for Automotive Innovation, which sounds like a neutral think tank, doesn't it? But the filings show it's the primary lobbying arm for Ford, GM, and Stellantis. The argument is, when you hear security risk, look at who is writing the checks for that message. So, why go to all this trouble? Why spend millions on lobbyists rather than just building a better EV? Because they can't. The core thesis is that legacy auto isn't scared of communism. They're scared of competence. Look at the unit economics. My analysis shows Ford is losing thousands of dollars on every single EV they sell. Their EV division is a cash incinerator. Meanwhile, NIO is moving steadily toward profitability. If your competitor can build a better car with better tech for less money and make a profit while you hemorrhage cash, you can't win a fair fight. So you try to get the runner disqualified. Let's move to the numbers. The January trap. This is a classic example of using short-term data to distort reality. Recently, social media has been flooded with charts showing sales of the Envo L60 falling off a cliff in January. Short sellers are screaming that demand is collapsing. But my analysis argues this relies on ignoring the Chinese calendar. Exactly. The Lunar New Year is a massive societal pause. Factories pause, logistics freeze, dealerships close. Comparing January sales in China to December is like comparing US sales on Christmas morning to a regular Tuesday. Of course it's down, it's seasonal, not structural. But there is a number hidden in that slump that matters. Despite the holiday shutdown, NIO still delivered 27,182 vehicles in that period. That represents a 96% year-over-year increase, nearly double what they did the previous January. If a tech or pharma company grew 96% year-over-year, Wall Street would be popping champagne. But the headlines focus entirely on the month-over-month dip. Why focus on the dip? Financial motivation. My research suggests short sellers are amplifying negative news to cover their positions before Q4 earnings are released. They project NIO will show its first adjusted operating profit. For a growth company, flipping that metric to positive proves the business model works. If you are shorting the stock, you need to exit before that news hits. Now let's look at the hidden expansion, the logistics. This centers on a partnership with DHL in the Netherlands, specifically regarding the Holtum Hub. The smoking gun is the specific mention of Firefly in the deal. Firefly is their mass-market sub-brand, correct? Right. NIO is premium, Envo is mid-market, Firefly is mass-market. In my opinion, you do not sign massive logistics deals with a global giant like DHL if you are on the brink of bankruptcy. You do that if you expect to move a lot of boxes. This infrastructure build-out implies preparation for a volume explosion. While headlines scream dying company, the contracts say global expansion. Finally, the follow the money segment, the JP Morgan flip. This is fascinating. In Q1 of 2025, the fear phase, JP Morgan sold approximately 95% of its NIO shares. This validated the uninvestable narrative, but fast forward to Q4 of 2025. JP Morgan bought back in, heavily. They are now holding 12.7 million shares, worth roughly $64.7 million. They sold when it was crashing, helped fuel the panic, and bought back at the bottom? Essentially. Institutions have access to data we don't. They realized the bankruptcy risk was zero, and the profitability path was clear, so they loaded the boat while the average investor was told to run. It's the difference between dumb money reacting to headlines and smart money reacting to fundamentals. So, what is the big picture? In my opinion, the situation surrounding NIO and the broader Chinese EV market appears to be a textbook example of informational asymmetry, weaponized by incumbent powers to delay their own obsolescence. The narrative that legacy automakers like Ford and GM are merely concerned about national security rings hollow when viewed against the backdrop of their own faltering EV economics. It seems far more likely that they are deploying a fear campaign because they cannot compete mathematically with the unit economics and technological velocity of companies like NIO. The stark contrast between the apocalyptic media headlines, often parroted by analysts with questionable independence, and the hard data of NIO's 96% year-over-year growth during a holiday slump suggests a deliberate distortion of reality designed to spook retail investors, while institutions like JP Morgan quietly accumulate shares at bargain prices. The January trap is particularly egregious, relying on cultural ignorance of the Lunar New Year to paint a picture of demand collapse where none exists. Furthermore, the logistical groundwork being laid in the Netherlands with DHL for the mass-market Firefly brand is a smoking gun of expansion that fundamentally contradicts the dying company narrative. If NIO were truly on the brink, they wouldn't be securing supply chains for millions of future units. They would be liquidating assets. The JP Morgan flip, selling low to validate fear, then buying high volumes at the bottom, is a cynical but brilliant maneuver that underscores the difference between dumb money reacting to noise and smart money reacting to fundamentals. Ultimately, this isn't just about cars. It's about a desperate attempt by the old guard to use political lobbying and media capture to disqualify a competitor they cannot outrun on the track. The lesson here is clear. In a market drowning in manufactured fear, the only truth lies in the silent, boring moves of infrastructure expansion and institutional accumulation, proving that while the clouds of media noise are dark, the horizon of the EV transition remains undeniably bright for those building the actual future.